Here we can see, again, all of the gasoline, jet fuel, distillate, residual all put together to look at just what are the mobility stocks doing? What's the product demand of these pieces? And here you can see that we're averaging about 14.5 million. You know, when you look at that 4 week rolling period, that's what we're sitting at, which is a bit low versus what we probably are. We're probably a little bit higher, something closer to about 14.8, 14.9. But you can see just how low some of that is on the with the fact that the current week is sitting at 14.39 million barrels per day versus last week of 14.066. So there is an increase, but not a huge increase in general. So when we start looking at what happens next, you can typically see that as we go into Labor Day, you get that spike. In 2021, Labor Day happened to be the biggest spike versus the other, even July 4th. And when you look at some other years, 2018, even 2019, 2018 was again high. 2019 was right around where we were for July 4th. So we will get a spike. Like, that's an increase that's going to happen, but we just don't see it going above July 4th. And then we see it again falling back quickly. And that just is going to put us firmly at about 14.9, 14.8. And then you can see that there's a drift lower. And we just assume, based on what we've seen so far, the drift lower is going to have the same rate of change as 2021, because you can see it was very similar to 2018. On that seasonal drop as we go into the end of September, and then you bump sideways, we expect something the same thing, but instead of putting us at about 15 million barrels a day of demand, it's going to put us at about 14.5 million barrels, 14.4 million barrels a day. And there is some risk to the downside on that. We don't see much risk to the upside. But again, that's just where we see things shaking out, which is going to be firmly between where we were in 21 and where we were in 2020. Now, when we start looking at the distillate and the different breakdowns of each one, here you can see that distillate had a small build of 110,000 barrels. That's still 34.9 million below the average. Pad 1 had a small build of 230,000, but that's 22 million below the 5-year. Pad 1 is where the pain really hits, because that's where we see the shortfall. Now, given all of these other areas are still below the 5-year average, but like Pad 2 is 5.7 million. Pad 3 is 6 million below. So we're not looking at a huge difference, especially when you think about the 5-year being skewed by 2020. But Pad 1 at 22 million barrels below, that is a huge problem as we head into winter. That's why imports are going to remain elevated, as we've been saying. Another increase of 35,000 barrels a day, with increases into both Pad 1 and Pad 5. And that's again going to continue Asia into Pad 5. We've talked about there's another 440,000 barrels a day, tons coming into the Americas. And that's going to be a mixture of the Atlantic Basin as well as what's going to come into Pad 5. And that's going to continue to be the case, just given where storage is and where our market sits, just based on pricing. So here you can see that distillate, and again, when you look at the 29-year average, look at the rate of change. It normally still continues to go up. Instead, we've just gone sideways, and we're not seeing. So even though we're getting builds, we're not getting builds anywhere near what is needed to prepare us for the winter months. That's when we start looking at fuel oil inventory in Pad 1. And you can see that, again, even though there was a small build, think about how far away it is, and in the size of the build, the rate of change, very low, keeping us under pressure as we head into winter. Pad 3, fairly stable. You can see here it's still a little bit on the low end, especially even if you take out that yellow line, which is 2020. We're still on the lower side, but manageable. Like, we're not looking at too much, too little. We're sitting there at a fairly flat component, and that's what we're going to see maintained, because the refiners obviously have spare capacity in storage on both the distillate side and gasoline side. So if Pad 3 refiners can source enough crude, and that's a big if, to increase the distillate cut, that is something that they would target. And this is a beautiful point to have the Keystone Pipeline bringing down that delicious Canadian crude, because there is a large amount of distillate in that oil that could be created to, again, alleviate some of these issues. So now when we look at product supplied for distillate, here you can see that sizable drop. We were expecting to have a drop, again, staying below the 5-year average. But it's just when you look at seasonally, there's normally a spike. Instead, we had a spike down. So we will get a makeup number, which is, again, just going to put us right back at the 5-year average. We don't see this moving up or down, but staying fairly stable, just given, even as we've seen a slowdown in some of the trucking, it's still at the higher end, and you could see it flattening out. Last week it was 54. Now it's 55.5. So you're still essentially holding it at the highs from 2018. When you look at load availability, still down, and we're seeing now some big companies shutter just because they can't manage. They costs are, labor still high, diesel prices are still high, which we're going to talk about in a minute. But there's still cargoes to move. But when you look at rates have come down because people they're not willing to pay up. They'd rather live off of inventory or utilize the rail system as much as possible, which is crimping against some of those margins. So now when we look at rail traffic, it's up 3.4% over 2021. Coal, again, up there. We're going to talk more about coal on the Econ show because things are running very light right now. Grains continued to surge, up 12.9%, which is above last year, which was a huge number as well. But when we look at petroleum products and some of the others, there's a bit of a slowdown, with intermodal having a nice bounce. And again, as you see a little bit less on the trucking side, you're going to see more on the rail side, and that's what we continue to see. But then what's coming into the U.S. continues to be down. When you look at the underlying flows, when you compare it to the previous year, you can see that we're still well below the previous year by anywhere from 20 to 30%. But last year was also a massive year. So when you look at it, you have to put it into context. It's still a lot. It's just, again, not what it was. So that's where we still have enough to keep things moving and to keep the trucking industry consuming diesel, but not anything that we've seen like we saw in 2021 by any shake of the imagination. Now, for those that haven't seen it, California is telling its residents to avoid, turn your AC to 78. Turn off your lights when you can. Try to conserve energy, especially between the hours of 4 p.m. and 9 p.m. If you can, don't charge your EV car. And it's just kind of laughable on that side. But again, that's a story for a different day. But when you look at just natural gas consumption, you can see that most of the U.S. is either well above or at least above their normal temperature outlook, with the South seeing a little bit below normal. But realistically, when you just look at natural gas consumption, this is going to maintain natural gas consumption within the U.S. at a fairly stable clip. And again, supporting natural gas. Right now, we're at about $9.14. And just given where we are, where the demand is, where cooling demand is going to be, we don't really see any real change in those numbers. Gasoline had a draw of 1.17 million, 17.5 million below the 5-year. But when you look at Pad 1 had a draw of 1.74, 10 million below the 5-year. And again, that's where we continue to see those disconnects. Pad 3 had a build of 1.99 million, and it's right at the 5-year. So realistically, it's Pad 2 and Pad 1 that have the shortfall. Pad 2 is 4.8 million below. And with having BP whiting down, that's going to accelerate the pull from both distillate stock as well as gasoline stockpiles, just because of that disconnect where, yes, you're not going to have as much crude going in, but you're going to have more product going out, all because of that disconnect. When you look at storage, you can see the rate of change is typically accelerating to the downside. Instead, we're flatlining. When that's something that we think is going to remain the case. When you look at imports were down 30,000 barrels. a day. Pad 1 was the driver of it, down 36,000 barrels a day. But that's 262,000 below the 5-year. And that's, I think, the biggest issue when we look at August, typical August moves. We should be at about 700 to 800,000 barrels a day, but we're just not getting that. And there's when you look at tanker rates are very elevated given the amount of product that is moving about. And the length of time. Again, miles per ton matter when you look at absorbing any spare capacity on the shipping side, pushing up rates, and then supporting rates where they are. So that's where the disconnect is coming from Europe into the U.S. Because even though the U.S. market, especially the East Coast, has spare capacity, it's not being priced as such. And that is, again, keeping that product stuck within Europe. So then when you look at total inventories going over time, here you can see, again, that flatlining as you have the comps coming down to meet you. And that's where we see things continuing. On the positive side, blending components had a draw of 2.64 million. So even though gasoline had a draw of 1.17, blending components had a draw of 2.64, which was obviously sizable. Now, typically I say that blending component, that bigger drawdown, is a positive when you look at those flows. But there's also the shift in product. So when we're coming to the point where September 5th, or at this Labor Day, is the end of summer grade crude gasoline. Summer grade gasoline is more expensive to make, has more blending components in it, and different blending components. It can't have benzene, and then as you get into winter, the grade changes. So sometimes at the end of this cycle, you'll get a dumping of blending components into the market because you don't need it, and you'll try to capture the market as it is. So it's hard to say, and it could be because right now you have blending components going in. A lot of these companies are going to pull down gasoline ahead of the weekend because you're going to have a big driving weekend. It's Labor Day. So these are some of the things that we have to look at. So you're going to have a very weird week or two until we settle out, given some of the noise that we're going to get from Labor Day. But that's why there's a mixture of how much of this is just putting it into the market because you're not going to need it for another 6 months, and how much of it is because you have guys and blending facilities pulling down more to, again, blend what you need for Labor Day and then replace it as we go into next week, because obviously you'll have more demand, people fill up their tanks, and then you'll have to replace it as we go post Labor Day. Now, it's not surprising, especially in the U.S., to see a nice little spike in Google mobility because we are coming into a longer weekend. This is, again, some of that pickup. There was an increase on the mobility across the board, which is a positive, especially when you look at Asia. Asia continues to hold in better than what I've been expecting. And then when you look at TomTom, which has been a bit of a leading indicator, you can see that there is some staying power there. Still below normal when you look at Europe and Americas, but again, improving. And now it's going to be important to see how much of that continues post-school, because right up in our view, we're going to hold at these levels, not because there's going to be the collapse of society, but just schools, and this is bringing to the end of summer, schools back in session, people are going back to work. So that's where you'll see some of that leveling out. And we do see a bigger headwind in Asia. It's just a matter of, obviously, the data does not support that. And it's going to be, are we missing something? Are people still going to drive, even though emerging markets continue to get hit fairly hard, especially with the strong dollar, as well as just on an economic basis. But again, what we see are a lot of leading indicators, and this is a current indicator. So maybe, again, the disconnect is just timing. I've always been known to be early, but that's going to be something to watch. But right now, it's still showing positive. It'll still show some additional demand when we look at the gasoline front. And we'll talk about that as we go into the next segment where we see Singapore storage and Fujairah storage. Now, as we were saying the last few weeks, we expected diesel to pivot back up and gasoline to flatline, not so much go higher, but just the rate of change of the price decline was going to adjust. But when you look at inflation, when you look at sticky inflation, that diesel number is way more important than the gasoline number. Now, the gasoline number is going to be great for, the way the consumer feels. That's what they're, again, getting hit with at the pump. You see that. You're using your credit card or cash to pay that number. Diesel is that sneaky piece that's buried within everything. And that's why we've been saying that we think we hold right around $5. Diesel's right now, nationally speaking, at $5.08. But the problem is you're already getting prices going back up and nobody has turned their heat on yet. When you think about diesel, road diesel and heating oil compete against each other. So as that goes up, and I mean, if we have a cold winter, you're going to see, again, that pressure to the upside. And that's what going to keep that inflation very sticky. And again, that PPI elevated and leading more into that stagflation. The blending components you can see here moving back to the 10-year average. There's typically that drop, and that's what I was trying to say here. When you look at other years, when you look at 2020, when you look at 2019, when you look at 2016, you typically have that end of season drop. And then you start to see a little bit, just a flat line, because then you prepare. And then as you go to the end of the year, when refinery run rates go back up, you need a place to put the stuff, because you're always going to make blending components, but you need a place to store it. So you kind of draw it down. And then as you pick back up those run rates, as you get towards the middle of November, and then you maintain that activity until the middle of February. And again, that's the winter utilization rate, because there's the two shoulder seasons, fall and spring, and then summer and winter is your peaks. So but you need to make room, because people aren't driving as much because of the weather, because there's not as many things happening, because summer is that big driving period, and that's where we see this. But how much of this is also that pre-fill ahead of the Labor Day pump push, and then the following week's essentially recovery from it. And that's when you look at, again, gasoline demand, there's typically that spike. So we do expect that spike to happen this week and then maintain for one more week before we get that drop down. We do think it'll be above the 2020 numbers, because 2020 is still at the very low end, but again, well off that normal average. Now, when you look at underlying activity, you can see workplace is coming back up. It'll drop a bit, but when you look at grocery, retail, recreation, transits, things are fairly stable for this time of year. But when you look at workplace transit, below normal, and again, that's something that we see maintaining, reducing the amount of gasoline demand during the week, because you're just not going to get the same amount of people driving to work. Propane had a nice build of 4.22 million. That's bringing us only 5.5 million below the 5-year. And you can see the rate of change is pivoted back up, and it's actually tracking closer to 2017. There's still, again, demand in the market, but as petrochemicals demand is slowing and naphtha is getting cheaper, this is displacing some of this NGL, some of this propane, which is going to be a bit of a headwind for pricing, which is something we want to talk about further in the FSC show on Friday. Jet had a draw of 1.08 million, bringing us 2.8 million below the 5-year. But here you can see that jet fuel had that seasonal spike. We've had it every year since, in terms of that pre-fill ahead of that nice little final hurrah of Labor Day, and then you can see there's a steep drop off, and again, we just expect to see the same thing, putting us back within the range that we've been guiding to. And here was, again, kind of falling into place here with that steep drop, and then we will get that nice little spike. In 2019, it was a little bit earlier. Here you can see from the green line, it was a little bit later, or I should say 2021, and we expect to see something very similar. It's not going to be, things are back to normal. It's just, again, that seasonal bump that is very much within the norm. And then following that through, the flight schedule for the 12 weeks ahead is 0.33% lower than the previous week, and it's going to continue to, again, be on that decline as we head into the winter months. Open table, nice little spike as we got into August 30th, and it will stay elevated as we go through Labor Day. It will stay elevated, but when you look at the U.S., again, we see it trending a bit lower just because you're coming to the end of summer. People don't want to, don't eat out as much. They have work 5 days a week and a little bit less. But again, because we're trying to compare it versus the other baselines, which is using 2020, so data for 2022 and 2021 and 2020 uses 2019 baseline. So it's just a matter of just where some of the numbers are. And again, we just see things being about 5% better than normal. But it'll be interesting to see how this drops off, because we've already seen some of the leading indicators showing a slowdown. And a lot of that is economically based, which we talk about in the Econ Show. And we're going to talk about again this week. So that's what we have for you for the U.S. and refined products. In the next segment, we're going to go more into differentials and some of the things that are happening in the global markets.